Welcome. It's episode number 45 of The Rent Roll, your podcast on all things rental housing, apartments, single-family rentals, and build to rent. Today, we're going to dive heavily into SFR and BTR with 5 key takeaways from the SFR REITs Q2 2025 earnings calls that took place last week. Lots of good color from those calls, as always, with coming from the 2 SFR REITs, AMH and Invitation Homes. A quick programming note for you. Next week, we're going to do the same thing for the apartment REITs, top 5 takeaways from those calls. So join us back next week for that. Now, for today's episode, after we review the top 5 highlights from the SFR REITs and review headlines and trivia, we have the honor of being joined by one of the founding fathers of institutional SFR, Sean Dobson, the CEO and chairman of Amherst. Amherst is, according to John Burns data, the 5th largest SFR owner in the country with more than 40,000 single-family rental homes nationally. Amherst is also doing some really interesting things on the construction front. Kind of a different form of build to rent. They're primarily building homes from a factory and shipping them to vacant lots. So we'll talk with Sean about that. We'll talk about the current SFR operating environment, and we'll also talk a lot about myth busting. And in particular, what's happened over these last 10 plus years where the narrative around institutional SFR has completely spun out of control, so far from reality, so far from the data, the things that get said and even reported. It's just sometimes this stuff's from La La Land and just not backed up by reality. So we're going to, Sean's got some really good perspective on all that as somebody who's obviously been on the front lines and also been someone who's been subject to some criticisms. And also, you're going to hear a really fabulous story from Sean about Warren Buffett. So stay with us for that as well. He's got a pretty good story there. All right, before we jump in further, big thank you to our sponsors. First and foremost, to JPI, a leading apartment developer with the purpose to transform building, enhance communities, and improve lives. And also to Waymaker, a multifamily investment group focused on attainable housing and also Class A market rate apartments, partnering with best-in-class builders across Texas and the Southeast. All right, so as always, we kick it off with, here's a chart. And instead of charts this week, we've got 5 key takeaways from the single-family rental REITs. Let's start off with number 1, opportunities to buy new homes at a discount from home builders. So this was a really interesting topic and obviously aligns with some of the broader themes we're seeing from the single-family home builders right now. Just challenges getting selling homes, newly built homes. Challenges among home buyers to buy at given where rates are today. And so now this is translating to better opportunities for SFR operators to buy excess inventory from the big home builders. Dallas Tanner at Invitation Homes, he said home builders now have inventory they want to move, they want to sell, get off their books. And so they're coming to the SFR operators and offering some of these homes at discounted prices. Dallas said this, he said, we're getting pretty significant discounts going in, which allows us to be really conservative on our underwritten rents. All right, so here's what he's saying. Here's the implication. Yes, some of these markets with a lot of single-family homes for sale are also markets with a lot of BTR single-family rental homes for rent, and that's been pulling down rent growth. They're softer for rents right now. But what Dallas is saying is that Invitation can now still be net buyers of new construction in this environment because of these discounted prices. They can underwrite to softer rent. So they're going to be playing the long game in growth markets that they like for the long term. In fact, Invitation talked a lot in this earnings call about still being focused on some of these high growth Sunbelt markets that are currently facing supply pressures, but those supply pressures are going to be coming down. Same thing in the apartment world as well. AMH, they've not been as active yet buying from home builders, but they said the same thing, and they see potential opportunities to be bigger buyers going forward. Their CEO, Brian Smith, he said that in the recent past, there was, quote, not really much change in willingness to negotiate on price. But then he added, quote, we see a little bit of change of late from some of the large national builders and some of the markets that have maybe seen a little bit of extra supply, we're seeing an expanding willingness to negotiate on price. And it gives us a lot of optimism as we get into the back half of the year on that particular acquisition channel's potential. All right. And also, by the way, as a side note, Brian said the same thing about land sellers. And, AMH also does quite a bit of development, which we'll talk about in a minute. But he said that, well, in the recent past, most of the price cuts were coming in less desirable, further flung locations. They're now starting to see better pricing for some land in better locations. But anyway, maybe there's a broader pivot here. We'll see. But back to the homebuilders topic, that's going to be something to watch more in the second half of the year. How much can these SFR REITs and also their peers be opportunistic buyers from home builders, given lack of demand from individual buyers right now, given where mortgage rates are? Number two. Second theme from these SFR calls, continued growth through new construction while still being net sellers of existing homes. Okay, so speaking of construction, and contrary to all the headline narratives, this is getting one of those things also, today's headline narrative and policy narrative doesn't really align with the reality of what's happening in the last few years, not just even right now. The SFR REITs and their peers continue to focus on growth through new construction, build to rent. And then for existing scattered site homes, the REITs are generally net sellers. They're selling more homes than they're buying. And even these last few years, a lot of what they have acquired has generally been through portfolios of SFR portfolios, our homes are already rentals, as opposed to being big active buyers off the MLS. Invitation Homes said in Q2 they acquired 1,040 homes, much of that from home builders, total cost of $350 million. They sold 358 homes for a total of $141 million. AMH said their in-house development program delivered 636 newly built homes in Q2. They also recycled some capital, selling 370 properties in the second quarter for approximately $120 million of net proceeds at an average economic disposition yield in the high 3% range. And do you want to know how many existing homes they bought, individual homes that they bought in all the second quarter, AMH? How many? 5. Not 5,000, not 500, just 5, as in 1, 2, 3, 4, 5. You count all the homes they bought on one hand. So that means for existing homes, AMH was a net seller of 365. And that, again, that's kind of been the story for a while now, not only for AMH, but for a lot of their peers as well. So why don't we ever see that make headlines? And on this topic too, recycling capital has been a big theme for both apartment REITs as well as the SFR REITs. Invitation also gave some good examples of, given where they can sell at value, essentially cap rates. Individual buyers don't think about a cap rate, an SFR company is, and so if you can sell in these 3% cap rates, and then buy new homes at 5 to 6% cap rates, that's an attractive opportunity. And so Invitation gave examples, maybe being net sellers in Southern California, and then recycling that capital in the new construction in Atlanta. Just as one example. And so that math is becoming more favorable, and that's a big reason too why you're seeing this shift to newer homes. We've talked about this in the past too, but obviously new construction also allows for reduced maintenance costs or more attractive homes to rent out. You could also a lot of times use a lot of the same parts and materials and what's sort of appliances that allows for easier ongoing maintenance also. So there are a lot of advantages to newer construction. Let's move on. Number 3, the third big takeaway: return of normal seasonality. So this is an interesting one. Chris Lau at AMH, he pointed out that COVID and the era that followed really skewed and distorted normal seasonality and the normal seasonal leasing curve that stacks the bulk of the demand in the spring and early summer. That's traditional. And that hasn't really been the case for these last few years. It's been since COVID, not only for SFR, but also for apartments. But this year, Chris said that they saw more normal seasonality again, with leasing peaking in late May and early June. And he added, quote, "One of our key objectives for this year was to help flatten the shape of the seasonal curve so that we can avoid the type of steep leasing deceleration we saw in the back of 2024. And we've been really successful accomplishing that this year through the Lease Expiration Management Initiative, where we've shifted expirations from what was called what was 50-50 before first half, second half of the year to what is now more 60% in the first half of the year, 40% in the back half of the year. And what that's done for us is it's enabled us to capture more new leasing opportunities during the prime leasing season. And importantly, it has shifted move-outs away from third and fourth quarters, which we expect to translate into less deceleration this year. Invitation Homes, too, spoke of, quote, normal seasonality. And they also noted that with that includes a bit more turnover in Q3 as well. So again, big focus on seasonality. I'm curious to see if we'll hear that from apartment REITs as well. Takeaway number 4, strong retention, strong renewal rent growth, and also strong renter financials. So this has been a continuation of story we've talked about for a while now, continued strong renewal demand. Obviously, it's more challenging for folks to move out and buy a home, but we're also seeing folks who are generally just preferring to stay put as opposed to even moving to another single-family rental home. And so, again, I always tell people all the time is obviously when it's harder to buy a house, people are going to rent longer, but that doesn't mean they're going to rent with you longer. They still have to want to renew with you, especially in a market like today where they do have more options. That's going to speak to, obviously, resident satisfaction, the ability to serve your renters in place and help them want to renew. And we're seeing that. The SFR REITs are seeing that. The apartment REITs are seeing that. And a lot of the broader industry is as well. Invitation said renewal rent increases averaged 5% or almost 5% in Q2. Let me get that number here. I think it was maybe a little under 5%. And then occupancy came in at 97.2%. AMH said renewal rents increased 4.4%, and occupancy came in at 96.3% for Q2. Some color here. Invitation Homes said during the second quarter, our average resident tenure was 40 months. Our renewal rate approached 80%, a continued testament to the quality of our homes, the strength of our service platform, and the trust we've built with our residents. Charles Young added, longer stays not only reflect resident satisfaction, but also contribute to lower turnover costs and better condition of our homes. Satisfied residents tend to stay longer and take better care of their homes, supporting long-term asset performance. So there you go. Oh, and then let me add one other thing here. I talked about this a little bit earlier, the financial strength of renters. And this is something that never gets enough attention outside the industry. We've seen a lot of chatter about the impact of student debt returning or student loan payments, other headwinds. But again, we just are not seeing that show up in the SFR or apartment data in terms of rent collections or renter incomes or affordability, at least specifically for market rate professionally managed rentals. In fact, as I've talked about previously, rent-income ratios broadly have actually improved. And so Brian Smith from AMH added some really good data here for their portfolio. He said AMH's incoming residents have income to rent ratios above 5x, which also could be translated to less than 20% of income spent on rent. And renter household incomes for them, for the AMH portfolio, now top $150,000. And he said credit scores remain strong as well. So I know some folks out there seem to be allergic to good news, especially on this topic, or want to try to explain it away. But this is objectively good news on renter financial health. Again, at least specifically for the professionally managed market rate market catering to mid and upper incomes. And so again, I tell people this all the time, you have to bifurcate. You have two things that are true at the same time. We have a severe shortage of affordable housing for those who need it. At the same time, there's been ample demand for market rate rental homes at today's rents. Both things are true. All right. The fifth and final takeaway. It's been a mixed bag for new lease rents and new supply competition. And this is one topic where we did see some differences between the two SFR REITs, where new lease rents are and how much new supply competition is in the market. All right. So with AMH, they reported new lease rents in Q2 up 4.1%. And I suspect that's going to be an outlier among most apartment SFR operators right now. We're just not seeing numbers like that for most of the country. Most of what we are seeing for new leases has generally been low single digits. Some are even negative, especially in the high supplied apartment markets. But remember, even with all the headwinds toward buying homes, SFR rent growth nationally has been in the low single digits. Most of the exceptions are generally in low supplied markets like the Midwest or Northeast. So again, AMH is probably going to stand out here a bit. By comparison, Invitation had new lease rents in Q2 up at 2.2%. In fairness, Invitation's occupancy rates and renewal rent growth were also a bit higher than AMH. So, both REITs have their bragging points, but it's really the subtext of the new lease rent story that's maybe more interesting. AMH said their leasing foot traffic was up 5%. They said they're seeing very little competition from new supply in their markets. And again, that's quite a different narrative from what we're hearing from others in SFR right now. It differs from what Invitation talked about with increased BTR supply, and it also differs from what our guest today, Sean Dobson at Amherst, is seeing in the market as well. A couple of things of note here. Number one, some of this, in terms of new supply competition, it's going to really vary based on product type and location. AMH talked about being insulated in some of their locations and also in a product type very focused on traditional detached single-family homes as opposed to detached single-family or townhomes, denser lots, et cetera. Also, some of this is timing based. Like with apartments, we're at the tail end of the peak supply wave for BTR. So supply winds are going to start mitigating in some spots and likely continue to nationally into the next year. A couple of quotes for context here. First of all, Charles Young at Invitation, he said they expected competition from BTR supply in some of their bigger markets. He said that's impacting the new lease rent growth, of course. And he said, quote, "The good news, we're past the peak of deliveries and we're watching that now. We expect that they're going to continue to come down the second half of the year, but we still have some absorbing to do. And as we do that, I think we'll be pretty well set up for 26. How quickly each market kind of absorbs is going to vary. We're seeing good signs as you look at Orlando, Texas, Phoenix, Tampa. We're keeping an eye on it. Demand is still here. Just in those bigger markets, we're having to absorb and stay on market a little longer and fight for that rate in the new lease side and balance that out with occupancy." Okay. So again, what he's saying is there's a lot of demand in the market. It's just being spread across more properties, which obviously has been happening on the apartment side as well. So as a result of that, units are sitting vacant longer between leases. So typically you want to protect that occupancy rate. So you're gonna pull back on new lease rent growth in order to keep those units full, because that's what ultimately you want. There's, again, no revenue comes from a vacant unit. At AMH, Chris Lau said this, so a different perspective here. He said, if you look across our 30 plus markets, we're seeing very limited supply in the vast majority. He said that even in the higher supply markets like Phoenix, Texas, and Florida, he said AMH is actually performing well and they're not seeing much impact on occupancy. And why is that? In his view, quote, one of the key factors that we have, not only let me redo that again. One of the key factors that we have, not only the benefits of the diversified geographic footprint, but it also has to do with our product type and location within these markets. So again, emphasizing, detached single family homes. All right, so there we go. There you have it. 5 key takeaways from the single family rental REITs Q2 2025 earnings calls. Again, next week, we'll do the same for the apartment REITs. And then also later in today's program, we're going to dive more into these operational themes as well as some SFR myth busting when we welcome in Sean Dobson from Amherst later in the program. But first, rental housing trivia. All right, today's rental housing trivia is presented by Elise AI, which is bringing AI-powered tools into the property management space. And by the way, I'll be joining Elise AI for a webinar on August 20th, talking about navigating today's market of compressed NOI and what the road to recovery might look like as well. So I'll be sharing lots of data, and also we'll be talking about strategy as well for more efficient operations. And it's a free webinar, so you can sign up for it at eliseai.com/webinars. All right, so today's question is, what single-family rental company had its IPO in December 2012, becoming the first publicly traded SFR REIT? Okay, what was the first publicly traded SFR REIT? Next up in the news. And of course, we'll get back to our trivia answer later. But let's touch on the headlines first. Our first headline is about someone we just spoke about. The current president at Invitation Homes is leaving Invitation to become the new CEO of Sun Communities starting on October 1st. This is, of course, Charles Young. Charles has been the president, previously COO at Invitation Homes under CEO Dallas Tanner. So he is leaving to now take the CEO role at Sun Communities. He succeeds Gary Schiffman, who is retiring after 40 years leading Sun. So 40 years, that's a heck of a run. Sun is a REIT focused on manufactured housing and RVs, for those of you who don't know. So certainly an adjacent space, but a different market. So at Invitation, Dallas Tanner is going to, in addition to staying CEO, is assuming the president title. And they've also recently promoted Tim Loebner into the COO role that Charles previously had. So big congrats to Charles and also to Tim. Our next headline comes from Pew Research and Pew Charitable Trust. And some really fantastic work here. The headline is New Housing Slows Rent Growth Most for Older, More Affordable Units. Data shows that limited supply is associated with greater rent increases in low-income neighborhoods. All right, so this is fantastic myth busting. Let me read a little bit of this to you. It says the nationwide housing shortage has driven up rents more in low-income neighborhoods than in the U.S. overall, but in areas that have recently added large amounts of housing, rents have fallen the most in lower-income neighborhoods with older buildings, according to analysis of publicly available housing data. These results are relevant for policymakers concerned about renters' displacement as the costs of housing rise. The findings suggest that not allowing more homes to be built, even for high-income residents, pushes up all rents, making it harder for low-income tenants to remain in their neighborhoods. All right, so I couldn't have said it better myself. This should be common sense. Somehow it's not. So hopefully this excellent research helps move the needle to people who struggle to connect the dots. So again, anytime someone says, hey, we don't need more market rate luxury housing, we've seen affordable housing. No, you don't. You need all of it. You need all of it. You do need market rate luxury housing because that's pulling up higher income people out of these more moderately priced units into the higher priced new units. So if you want more moderate and lower priced affordable units, you can build those, sure, but don't build that at the expense of the top of the market as well. You need all of it. It's all of the above. It's both and, not either or. All right, before I move on a somber note here, I want to take a moment to honor the legacy of Wesley LePatner. As many of you know by now, Wesley was an executive at Blackstone and the CEO of REIT. She was lost in the senseless tragedy last week at 345 Park Avenue in New York. Sure wish I did. It's clear to me that she was the type of person who made the impact on people that all of us aspire to make. I shared some tributes to Wesley on LinkedIn, taken some kind of a compilation of tributes that people who knew her wrote about her. And so if you want to see that, you could find that on my LinkedIn profile. I wanted to read one of them here because it really resonated to me as a dad of young kids. And this comes from Dan Goldberg, and he wrote a tribute. He wrote this on LinkedIn. He said, when I was on Wall Street and had my first child, I remember Wesley LePatner pushing me out the door in the middle of a hectic Wednesday workday to attend a toddler music class. She said, you won't get this time back, and you won't regret it. Of course, she was right. I treasure those memories even more as my kids get older. Taken alone, those words might not seem profound, but in an industry known for grueling hours and a culture of pushing through at all costs, Wesley stood out. She showed me that you can rise to the top and still show up fully as a parent and a great human. That kind of leadership made a lasting impression. So thank you to Dan for sharing that story. My heart breaks for Wesley's husband, her two kids, her family, her friends. Her funeral was this past weekend, and I saw a video shared on the news of her daughter giving a eulogy, and she called her mom her rock. It was really tough to watch, and obviously no child should have to be in that position, but it was also very clear what an incredible mom she was, in addition to being a titan in the business world. So Wesley, you made an impact in this world, and we honor you. We honor your legacy. All right, there's no good way to pivot off such a somber note, but let's get back to today's rental housing trivia. Again, the question was, what single-family rental company had its IPO in December 2012, becoming the first publicly traded SFR REIT? And the answer was Silver Bay, which was later acquired by Tricon in May of 2017. All right. So with that, we're going to jump into today's interview. Our guest today is Sean Dobson from Amherst. So please join me in welcoming in Sean. All right, now welcome into the interview portion of today's podcast, and I am honored to welcome in the founder, the chairman, the CEO, and still also the chief investment officer of Amherst, Sean Dobson. So Sean, thank you so much for being here.
Hey, thank you for having me. Been looking forward to this.
Yeah, no, I'm excited to chat with you. And I got to tell you, as a research nerd, I got really excited when I think it was maybe another podcast you did or an interview or something. You mentioned that you started your career in research. So is that right? Is that true?
That is correct. That's the big secret that we try to hide at Amherst is that it's a nerd-filled platform.
I love it. And I want to ask you about this because, a lot of people get into real estate because they love the art of the deal or they're Excel junkies. They like, the people aspect or finance. But I'm curious to ask you, how did starting out in research ultimately help shape your career and all the success that you've had?
Well, I think that I learned early on that the difference between sort of an objective decision and a subjective decision. And it's super helpful to sort of take the emotion and the instinct and the intuition and the gut feel and all that stuff that I think some people are way better at than me and just try to boil it all down to as much math and as much hard data as possible. And so when you're writing research and you're supporting an infrastructure from a director of research position, that's kind of like job one, is to make sure that you have the facts to back up your statement. So then as you become an investor, then you're sort of used to having to have all the facts in place to support your decisions.
Well, yeah, you're speaking my love language. I get it. That's fantastic. All right. So I think your business is unique. You started off, you're in broadly the real estate market prior to, the GFC and the run up of single family rentals. But I want to just fast forward to 2012 when you got into the single family rental business. Again, you already knew the single family home market with Amherst being in brokerage and finance, but you saw an opportunity to pivot into what had been and still is a very mom and pop business in SFR. So I'm really curious to ask you, what was the aha moment that made you realize that, hey, there's a real opportunity here?
Well, I think that it's kind of interesting because the original thesis was totally wrong, right? The original thesis was that, let me say, what we saw as the opportunity was a little bit different than other people. So clearly home prices had fallen a lot and we understood that the market was going to continue to fall if we kept trying to sell homes to individuals who were going to go out and buy, get a mortgage, buy the house and live there because we were running out of that pool of counterparties. So we kind of got the joke that there was going to be this big alternative use for the asset. And the thesis was that there was enough infrastructure in the United States to be able to do that on an outsourced basis, that there were enough people in the field services business that supported the mortgage companies. Whenever a home defaults, there's a company that you can hire to go and secure the home, paint the home, get it prepped for sale. The real estate agents that handle leasing. And then there was a huge network of property managers throughout the country. So our original thesis was there's going to be a big need for rental, following the demise of the subprime mortgage market. The home prices are very attractive because they're so far below replacement value. Their free cash flows are so high. And that as an institutional investor who's accustomed to sort of outsourcing the nitty gritty, we would just be able to run that playbook. And so our view here was our job was to connect institutional capital to the equity in single family homes. What our job became was far more complex because ecosystem, we couldn't figure out how to use the existing ecosystem to do what we needed to do.
Yeah, so that goes into another topic I want to ask you about. So, I mean, you're going back to an era when obviously institutional SFR was a totally unproven concept. And I even remember, I'm sure you do as well, people like Warren Buffett and Sam Zell really doubting that this could ever be, a national portfolio and scalable, given all the operational challenges that, better than anybody. But as you think back to that initial investment thesis and strategy, you mentioned some things that you got wrong, but I'm curious just more broadly, I mean, what did you also get right? And what did you have to adapt for this to work?
Just as an aside here, before I answer that question. So when Warren Buffett went on CNBC to talk about if I could buy 50,000 homes, I would.
Yeah.
And they're invaluable. He had just read a letter from me
Wow.
on the fact that we were about to buy 50,000 homes. So I called him. It's like, dude, like let's don't make everybody aware of this trade. Like, what are we doing?
That's
and
amazing.
Sam Zell spent his last birthday at my house.
Wow.
And I got to chat with him about sort of our experience and what he thought was going to be hard. And like, he was correct. He was like, you can't operate it with the existing commercial real estate operating infrastructure. You had to build a bespoke platform. And one of the guys that was on my chairman's advisory board is a guy named Bill Bayless, who was considered the godfather of student housing. And it was super helpful to have Bill around because he had been down the road of, a difficult to operate piece of real estate, not accepted by institutional investors. And then how do you sort of square the circle here, right? But it's kind of wild. And I would say, look, the people that were like, you can't do it, I think they were right, because you couldn't do it with anything that existed. You couldn't take a multifamily model where you have a leasing agent, a property manager, a make-ready team, a super and a customer service team sitting in one place serving several hundred residents. That model doesn't work. But I think the thing that we figured out maybe a little bit quicker is that the expectation for someone living in a single family rental is not the same customer expectation as you would have living in a high-rise apartment that has a doorman. And I think that gap of like what the product is, what the expectations are, and how you manage that customer experience is the key to being able to successfully operate scattered sites, SFR.
So it's just as a follow-up on that then. So could you tell us kind of what you learned those early years then of like how you had to adapt that model to work? And you mentioned the things that's different. I mean, were there any kind of just early learnings that say, hey, look.
I think we learned that things to and from the home was way less expensive than people would have thought. So like the scattered sites nature of it wasn't nearly as big a barrier as people thought. I used to give this example of like at the time, this is in a different price area, but you'll remember that at one point, Domino's offered a $6 pizza, and if they didn't get it in 30 minutes was free. And I would say, guys, like, don't tell me like getting to the home is complicated, because for $6, they get the Super Bowl ad, they get the TV ad, they get the pizza, and they get the delivery. And if they don't get there in 30 minutes, it's free. Like, don't tell me that we can't get out to our homes if we need to quickly, right? So
that's fantastic.
So we figured out that scattered sites space barrier wasn't, or distance barrier wasn't as big an issue as people thought. But we also figured out that alignment matters, right? You had an industry of at the time, a lot of people don't know this, Jay, but a lot of the defaults from the subprime era were small investors with rental homes.
Yeah.
And we called them like the little mini Donald Trumps who would go out and buy 6, 8, 10, 15 homes, and they would hire a property manager. The problem was that property manager wasn't really aligned with the outcome for the investor. So that investor wasn't thinking about net operating income. They weren't thinking about rent growth. They weren't thinking about compliance on behalf of the resident. So when we tried to go level up those things, what we ended up doing was recruiting a bunch of people out of those platforms who were super smart people, but just gave them different alignment. I think that understanding the alignment piece was a big deal. Understanding that getting to and from the homes is not a big a deal. It kind of gave us the courage, if you will, to keep trying to perfect the operations side.
Yeah, that's great. And our younger listeners won't appreciate that Domino's example, but that's a good one. Yeah.
Well, it was $6.
Yeah. 30-minute promise.
Exactly.
And by the way, one thing, where did the name Amherst come from?
So it's interesting. Amherst was on the door when I bought control of the firm in 2000. And so the firm was founded in 1994 by a group of people. And I guess they had an affiliation with Amherst. I never did figure out why.
Oh, that's amazing. You just kept the name. You just liked it.
Well, it was a good brand. This team had built a company that was focused on mortgage-backed securities. It was all secondary markets trading. And they provided a really valuable service to large investors, because those large investors, whenever they're investing and they call up a big bank and they want to buy $100 million worth of bonds, there's a lot of people that take the phone call. Whenever they put that into, a lot of sub accounts, and sub account needs to reposition and they need to sell $100,000 worth of bonds, well, really no one wants to make that phone call. So Amherst had built a name in the mortgage market as being kind of a, not that small lot size, but being the place to go where they would risk their own capital. They would invest their own dollars to support an inventory of these smaller odd lot mortgage-backed securities. And then they built on top of that from like 1993. So I took over in 1990, in 2000, bought control in 2000. And that's kind of how you tie the Amherst story to SFR, is that by the time you get to say 2005, 2006, where we sold that platform. It was eventually a primary dealer, but it became an issuer of new issue Freddie Mac and Fannie Mae agency CMOs, a market maker, and all kinds of pass-throughs. It was a $50 billion a month trading platform of mortgages that are not sort of the generic simple mortgages, the more complicated versions of mortgage-backed securities.
Interesting. Yeah, that definitely gave you, I think, a different angle into the market since since you're one of the, again, few groups that actually had some background in the single family world prior to SFR, institutional SFR.
We understood the capital market to understand the valuation, understood the risk. And as my former vice chairman, who passed away in March of 2020, would say, we came to the property management business unencumbered by prior experience.
That's great. So as time goes on, one of the things I'm really curious to ask you about, and I've been fascinated with how the public image of institutional SFR has eroded over time. And, I'd argue, I'm sure you would too, largely due to misconceptions and false narratives. But I remember in the early 2010s, there were a lot of headlines. I think even a Federal Reserve paper written on institutional SFR capital being rescue capital, helping stabilize home prices, get vacant REO homes out of disrepair, get them occupied again. A lot of them are just sitting vacant in bad shape, giving underwater homeowners an exit if they needed one. And obviously today it's a very, very different tone. A lot of it not even grounded in reality.
I know. It's like we stayed at the party too long.
Well, so yeah, what happened? I mean, how did the narrative spin out of control?
I have a lot of responsibility for this personally because we didn't. Yeah. The narrative was so bizarre and so wrong-headed that I'm like, no one's going to believe this. Like this, we don't need to get this. We're not lizard people. We're not aliens. So we don't need to respond to those accusations, right? But somehow the proponents of this anti-investor philosophy were so effective that they got a really, really kooky theory to become like the base narrative that large investors supplying capital to single family homes is a bad thing. And then you're going to get me all mad and start cursing. But I've been at more closing tables than most people, right? So I had a $50 billion a month business of supplying capital to people to buy homes. So the institutional investors have always been at the closing table. They're there with 75 or 80% of the money every time you close. The shutting down of the subprime mortgage market is something we lobbied against heavily, because just because you don't have a high FICO score doesn't mean you shouldn't get a chance to buy a home. But when the market closed for subprime, for like less than prime borrowers, we said we got to go because the people are still there. The need for housing is still there. The house is still there. What's missing is the capital, right? No one had ever scaled these micro investments, right? So we don't managing these homes is interesting, and everyone in my seat wants to give you big numbers because billions of dollars sounds cool, but we manage a business that has an enterprise value of about $350,000. It has annual gross potential revenue of about $24,000, and it has a gross potential profit of about $15,000, right? So that's the business that we're in. And we said, okay, well, that business, you can go get a mortgage for most of the $350,000, but there's like $75,000 or $100,000 of equity that's going to have to be put into this home before it can be a living unit again, and before people can raise their families in it, because the subprime mortgage market isn't going to finance it. And what we saw was just a massive demand function for people who want to live in this housing product. And I talk about this a lot, that housing is a consumer product, just like an iPhone or a Ford F-150 is a consumer product. A house is a consumer product. And there's a point in your life where the particular asset that we're focused on, the particular type of home we're focused on, fits a certain stage of life, a pretty long stage of life, from some sort of first kids to empty nester. Like that's the product that we serve. And a large and growing share of the U.S. population is no longer allowed to access that home as a buyer because the mortgage market won't fund them. So this narrative is confusing to me, because it's like, I've always been at the closing table. I've always been this big, and like institutional investor is bad. I mean, we manage money for teachers and for policemen and firemen, and somehow we're institutions and we're bad. And we've always been at the closing table, whether it was providing a mortgage or a first lien or second lien mortgage. And now the mortgage market is no longer fungible. Like, you can't make a mortgage to someone with a FICO that's 625. And 625, by the way, isn't the hard FICO score to find yourself with. You didn't murder someone to get a 625 FICO. Like you missed 2 consecutive credit card payments, right? So this population used to be able to get a mortgage and pay a slightly higher rate to offset for their credit default differences, and then they got shut down. So when Dodd-Frank passed, we spun around and said, "This is subprime mortgages are over. Where are these people going to live, and what is the opportunity that goes in that?" And so that's what we thought was the thing. And like you said, I sat down with the Federal Reserve, and I sat down with Bernanke and Yellen myself to talk about the pluses and minuses of this, and they got the joke immediately that having an alternative source of capital for homes is a countercyclical sort of support. And, Chairman Bernanke's question to me was, can you manage them? And I'm like, we're going to find out.
Yeah.
And so I think that frustration around housing is completely understandable. I think like people want to buy a house and can't. The price is too high. The math doesn't work. It's a bit of an implied promise from America that you work hard, you do your part, and you get to buy a house, and you get to be a home, and you get to own a piece of America, right? Owning a home isn't just buying a place to sleep, right? You're owning a piece of the land that is the greatest country on the planet Earth. So we're all for it. But I think our position was, as hard as I lobbied against Dodd-Frank and as hard as I lobbied against shutting down providing mortgage credit to people with subprime scores, we're like, we can't change that. So what is the next best thing? And the next best thing is to let them live in the home and raise their kids in these neighborhoods.
Yeah.
Sure, everyone that comes on gives you the same speech. It's true that I grew up in single family rental, right? I grew up in bouncing around. My dad was an executive RCA. We moved a lot. And they picked a home based on where the best schools were for me. They didn't pick a home where it was some strategic allocation thing. And we couldn't afford to buy in the neighborhoods that had the best schools. And so we rented. So the narrative is like the experience of the narrative is super frustrating, because when I get to sit down with elected officials and I explain to them my experience, the experience of the customers I'm serving, those customers' other alternatives, right? In today's world, not some theoretical world where they can do a fractional interest or shared appreciation or somehow get a mortgage that they can't get, or the house is somehow going to be cheaper than it is. Not some fictitious world that we hope for, but like in today's world, that family has to get their kids into school tomorrow. And we have something that's highly affordable. It's great service. It's a great product. It's the place they want to live. It's a place they want to raise their kids. And we're the only way they're going to live in that neighborhood for our customers. And so I get it. I get it that we would love for our customers to be owners, not renters. That just means we need more subprime mortgages. I mean, our customers have us. What I tell people is I'll give you 3 numbers. You give me a better idea. 625 FICO, $350,000, $2,000 a month, right? That's the recipe. And if you can find some other financial solution for that, I'm all in. But we've tried. And until we have a hard conversation about subprime mortgages in the United States again, this is going to be the way that a big chunk of the population accesses the suburban experience.
Absolutely. No, it's such a great point, and it's powerful that you've been through it yourself as growing up. So my question is,
I'm not ashamed of
yeah,
it worked. It worked for me, right?
Yeah. Yeah, no, that's a great point. And I'm of the view, I think a lot of this, anti-landlord stuff is really rooted in a lot of anti-renter sentiment. Unfortunately, that we're seeing across our country, different communities. And so, I
have professional handlers, and they're all screaming right now when you gave me that opening, because I think that's exactly what it is. I think it's socioeconomic discrimination, and I don't want the person sitting in first class next to me that got there with a free upgrade. And I don't want the renter living next to me when I had to do all the things I had to do to buy, and they get to live there as a renter.
Yeah.
And I don't want the rotisserie of residences moving out. And it's perfectly okay for me to use the word renter and mean a whole bunch of nasty things that you can't say at Play Company. And we're like, no way, we're not letting that happen, right? We're just not. And so there's all this kerfuffle, but I would say the most damaging piece of the kerfuffle has been this sort of high-minded ESG mode of like, I'm not going to participate, and somehow that's going to be a positive thing. There's not the legislation and the regulations have been minimal.
Yeah. So you've been through these conversations for a long time, but what advice you give others who are listening, who maybe, newer to the industry, like what can we do to help address the image issues? How do you combat that with real facts around, providing homes for people who wouldn't otherwise be able to live in these neighborhoods because they couldn't afford to live there? How do we get the truth out?
The first thing is, I think that we got to own what we own, right? We have to own what we've done wrong, right? So if we give bad service, if we let someone live in a house with no HVAC, if a tree falls on the roof, we don't fix it. Like I have one of these this week where the vendor didn't seal off the roof and now there's a moldy ceiling. Like we got to be better. Like the institutions have to live to a higher standard, and they can complain about it and say it's not fair, but who cares? Like you have to perform at a higher level. You got to give the customer, the resident in the home, as good a service as you can possibly deliver. And when something goes wrong, you got to jump on their grenade, right? So if and by the way, like our like escalations of things that go crazy on a weekly basis is like 1, 2, right? And we have thousands and thousands of homes. So we're never going to be 100%. We're going to have that service call that takes too long. We're going to have that tree that doesn't get cleaned up. It's going to happen, right? So the first thing is way reduce the frequency of it happening. Second is when it happens, throw yourself at it because you're down on the count, right? Like no one's going to give you the benefit of the doubt. You're a big bad landlord. You're big bad Wall Street. You're a big bad institutional investor. And so you're just wrong. And so fix it and just be better But the other is I think that we don't spend enough time talking about people. When you sit down with jerks like me, the first thing you're going to hear is house this, house that, billions this, thousands this, right? We do a horrible job of like my family story, right? Like a relatively mid-level executive at RCA, a mom that worked whatever job she could find, and they both worked, and they had a small business. The business got caught in an energy crisis, and so they had to close it down. They had no credit, and they jumped from city to city chasing the economic opportunity that America provides, and weren't going to be homeowners, right? Because they had a small business and they blew up their credit. So, like, you want to help that family. You want to help my family, and we talk about the people that live in our homes. They're our families, and they are our families. Like we're them, and so I think we don't do a good job of like who's benefiting from this, because logically people can jump to who's not benefiting. So when big fat Sean from Texas buys another house, some family didn't get to move in, is their view. Some family didn't get to buy it. And it's true. Like there was probably a family or another investor, but there might have been a family that wanted them to live in that house, and I bought it and they didn't get to live there. And people get that joke and they're like, oh, he ran up the price and that family doesn't get the house. This isn't fair. They don't make that next step to go, well, is Sean living in all these homes? Like, what's he doing with them? And what were those other people's opportunities? They get this confusion that it's the same family, that the family that was going to buy didn't get to, and now they have to rent. And that is 100% not the case, right? So we lose 95 out of 100 deals that we try to buy, and we lose them to other investors and to homeowners. And the ones we get to buy ordinarily have 25 years worth of repairs and maintenance that they need. And that's how we make our money, by the way, is that the housing market is so efficient. You can't just go buy it off the shelf. You have to some value add piece to the thing. But I think that's the thing we do wrong, is that we don't talk about the fact that there are people living in our homes and their other choice is not good, right? We're providing them the highest value piece of real estate, the most space, the most other features in the places that they want to live, access to the schools. And people just can't get their head around like, well, why didn't they buy it? And I'm like, okay, well, here's the math, right? And the math, by the way, is going to take years to fix now, right? What this nation did in post-COVID pushed homeownership off probably beyond the generational time frame for a bunch of people. Like we're so far away from being able to sell and provide the median house to the median family that it's going to take decades to recover. So in the meantime, it's like I would love to have a solution for them to be a homeowner. While the world comes up and invents new ways for this, we're going to provide access to school tomorrow.
Yeah. And I've had this debate with folks too, say, well, if someone's a renter, they should be living in an apartment. And it's like, well, that's very discriminatory. I mean, not everybody wants to live in an apartment. If you have young kids, that might not be really feasible.
Say that people that fit this definition should go live over there.
Yeah.
We do that once. It used to be in East Texas, it was called across the tracks. Right? And so I thought we tried to squash that whole philosophy of this socioeconomic aggregation. And by the way, we're a large provider of housing through housing choice vouchers, right? So we've always just taken vouchers as they were just other forms of income and never thought about it differently. But the brilliance of housing choice vouchers is that people of similar socioeconomic means and maybe experiences can then disperse out into communities where they're more diversified. And that's what makes the nation stronger. So that's the reason that like the subsidy to a person instead of a subsidy to a project, I think is so much more brilliant. So that's exactly what we're doing. In many cases, it's not a voucher, but it's like if they can't get a mortgage, they're still going to live there. They're still going to get to send their kids to the same schools. But man, are we horrible messengers?
Yeah.
Because well, the facts are on our side and we get smoked every day by some simple narrative of like, oh, they ran up the home price, therefore someone can't get it. And I guess they didn't think that the house is going to sit there vacant or we're going to have like parties in it or something. I don't know. They can't make that next step. Like, oh, wait a minute. Someone who wasn't going to get to buy the home ever now gets to live there. Like that's the piece that we have to land somehow.
Yeah, no, absolutely. Well, let's shift gears to the current SFR market. Obviously, as we just touched on, it's a very tough market for home buyers right now. That means people are likely to rent longer, lower turnover rates in SFR. Affordability is a good tailwind, relatively speaking, for SFR. So why do you think, at least this is macro level, not necessarily anybody's portfolio, but at least for most markets, we're still seeing it's taking longer to lease available homes and new lease rent growth is trending below normal?
Yeah, this is the other part of the narrative that we never tell the story of. So this nation had an inflation problem that it couldn't get a hold of because of too much monetary and too much fiscal policy leniency, fighting a crisis that turned out to be a tenth of the scale that we thought it was going to be, right? Luckily, but too much stimulation for the level of economic contraction we actually saw. So the consequence of that is always that in tight markets, those assets, now that they're fungible, people will pay a lot for them. So we're in this situation to where the thing we don't get credit for is that us and other platforms and smaller investors put an enormous amount of rental supply on the market, enormous amount, and it's still growing. So the metrics so we have a bunch of proprietary data around. We're tracking every home in the country every day. Is it for sale? Did it sell? Is it for lease? Did it lease? Pricing, expectations, whatever. So think about it think about the Amherst system as like kind of like the New York Stock Exchange, except for it's all real estate. So we know everything that's happening. The metric I watch of like the supply of homes available for rent, it's up like 25% from pre-COVID levels. And
from pre-COVID
levels. Yeah.
Wow.
Yeah. So like the drop in supply of homes for rent post-COVID was very muted relative to the drop in the supply of homes for sale. And it recovered way quicker. And then it went ballistic. So what you're seeing is actually can be described as a very healthy demand function because the absorption rate isn't down nearly as much as we would have thought it would have been given this change in supply. So I think that the small landlord or the landlord operating the small asset is the reason that inflation finally abated because they created so much supply.
Yeah.
And that's why we see like our rent to income ratios, I think I mentioned, are in the low to mid 20s.
Yeah.
So like we're the ultimate affordable product, even though it's a $350,000 home in the suburbs. So yeah, I think you've got you've got a case to where there's a lot of supply. Absorption rate is lower than we would like, but adjusted for the amount of supply, it's actually pretty good. So and the way we look at it, by the way, is that I love static pool analysis, being a mortgage nerd, right? So we always look at like a group of loans and how are they performing over time. So that's how we look at everything. So if you take every batch of homes that comes to market today and you look at where that whole batch is 2 months after they went to market, right? About half of them are rented and we would expect about 2/3 of them to be rented. So they're taking a little bit longer to lease by that difference between the half and the 2/3. However, that's on like 25% more supply.
Yeah. No, so, and on that, I want to point out and guess your thoughts on this. So home ownership nationally had been going up from the mid 2010s, 2015, 2016, up until last year when rates started to shoot up. So that 25% increase in supply occurred at the same time that home ownership nationally, at least, was still going up. And so a lot of this
is new production.
Yeah. So this is just
production.
Build to rent and other factors driving this.
There's a lot of this. Yeah, there's a lot of new stuff in the exurb. So the rent performance and absorption rates in the exurbs are very different than. So like our business being focused on scattered sites, the reason we're focused on scattered sites is because of the first 3 rules of real estate: location, 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 right? So we have way less of our portfolio in build to rent because generally it's in the exurbs. And
Yeah.
the performance out there is the worst because they all kind of came on. They got, it's how Wall Street works, right? The hot investment at the moment was BTR. So all the money went in at the same time. All the projects got started at the same time. They all finished at the same time. And now you got to try to lease them all at the same time. And the housing market doesn't work like that, right? It doesn't create demand in response like that. So that's what's happening. The absorption rate for that stuff is lower for sure. But the cool thing is without single family rental, without the capital supply, without platforms like ours and the others, you wouldn't have had a takeout for all that new construction.
Yeah.
Because people invest in builders. This is the misnomer, is it like, Apple builds a phone that they really think we all want, and we do want, right? Real estate developers build what they can finance. And what you can finance are the things that you can see a takeout for, if it's a stabilized apartment complex or whatever. If you're relying on the consumer to show up with a mortgage to be your takeout, that becomes a very difficult thing to finance. So a lot of the new construction of single family homes in the country was because there was this new financeable takeout in terms of the single family investor.
That's a good point. I want to ask you too, there's an article you may have seen from CNBC about the rise in quote unquote accidental landlords. And you kind of alluded to this, but these are, smaller landlords, individuals unable to sell their homes. They rent it instead. How big of a factor do you think that is right now?
So I wanted to refresh the study so I thought this was the big thing with all these 3%. So I talking about when I was the head of research, my research was prepayments. It was consumer behavior around their mortgage. When did they default? When did they prepay? And what kind of incentives did it take for them to prepay their loan, or what kind of crisis or whatever did it take for them to default? And so that's the core of our intellectual property, is all this behavioral economics around housing. So what I was expecting to see is when mortgage rates were 3 and people wanted to move and the new mortgage rate was 7, is that they would just keep their old house and rent it because there's a positive arbitrage, right? It's like the yield on a rental home is around 5. If your mortgage rate's around 3, then it's a good deal to keep it if you've got a 30-year fixed rate mortgage. So we did a big study and we built a bunch of monitors to detect this. And man, was it disappointing.
Really?
Yeah. So given the level of detail we had, we were able to set up a trap to say, okay, let's go find all the people who bought their home, didn't rent it, because we know we're tracking every home. Is it listed for sale? Is it for lease? Is it owned? Is it vacant? Whatever. So we have it for every home in the country. So whenever it comes up for sale, we see it. Or if it comes up for rent, we see it. So we're looking for the people who bought a home. It wasn't for rent for a long period of time. Then it came up for rent. And that would be the people whose the title didn't change hands, but the home went from being an owner-occupied home to now available for rent. It's not a huge number. At least last time I looked at it, it wasn't a huge number. It wasn't like a meaningful contributor to supply. The more meaningful contributors were supply are new homes that were built. Sort of the exurban master plan communities, the build to rent stuff. And remember, about 20% of all new homes built get sold to investors. So that supply of new homes, I think, is really way more. The last time I looked at it, way outweighed the transition from an owner-occupied home becoming a rental home.
That's fascinating. Well, it's good data to have.
Yeah. Well, I'll update it and I'll send it to you.
Yeah, I'd love to see it. So you earlier mentioned that you would love to see more of your residents become homeowners. And so I want to ask this question. It's one of my favorite questions. I've asked this to the heads of Invitation Homes, AMH, Brookfield, SFR Group, Maymont, and all three have said that their portfolios would do better if the for-sale housing market was healthier. Rising tide boosts all ships, more economic growth, household formation, more value growth, et cetera. So I know you're a data guy. Do you agree?
So I think we should, being a data nerd, I'm going to make you ask the question a different way. So like the housing market being more healthy, like housing is very unaffordable. So is more healthy, more affordable, like lower prices and sort of lower interest rates and higher income, that helps the whole U.S. economy, right? And so if we can do those things, and I think we will do those things. Interest rates are too high, real rates are too high. Home prices are very high relative to where incomes are, but incomes have kind of lagged everything as well. So like I can say what we don't need. We don't need a crisis for our business to thrive. We don't need for the housing market to go poorly. And honestly, you don't want that because it drives up the offsetting, like if the view is, wow, if the home prices crashed, I could buy them really cheap. It's kind of a misnomer because the cost of capital goes way up because the risk premium on the asset goes way up. So it's like that doesn't help. So we want the housing market to be less volatile is what I think is the goal, but we certainly don't need it to be unhealthy. I would say that we would all benefit from higher incomes for our consumers and lower interest rates at the same time. And that's tough. The Fed has a hard time getting their head around that. But I think that they've really missed the boat on overestimating the amount of inflation that consumers are suffering for longer than they needed to. And of course, there's a lot going on in terms of currency manipulator, like the target for currencies and things. But I think that no, we certainly don't need the housing market to be suffering for our business to do well. And I got to tell you, the flow of the demand from consumers, like the segment of the population that needs our services, is huge.
Yeah.
So like right now, it's like the cost of capital is too high. The cost of building is too high to make it affordable for both the resident and a return for the investors. That's kind of where we are in the cycle right now. It's like there's a little bit of tension between where nominal rents are versus what housing costs are. But no, I would say that a healthy housing market in terms of expansion of production it will benefit everybody. And catch up what we always talk about, which is this deficit of supply that occurred.
Yeah, and certainly to your point, I think one of the great things from an investment standpoint, SFR has been resilient across cycles. I just look at it very simply and say, okay, we've seen better revenue growth when there's some better volumes of home sales in the market as well.
Yeah. No. I think that's the key is that you need consumers. The U.S. consumer needs a raise. And wages are up 15, 17%. The cost of living generally, the way that you actually measure is probably up 25%. So COVID cost people, they went backwards in terms of their buying power in most cases. So like the U.S. consumer needs a raise, and that creates a whole bunch of benefits, not the least of which is get more people to get into that credit box of being able to actually get a mortgage.
Yeah. So you've talked a little bit about build to rent. I want to get into that a little more, the BTR versus scattered SFR. And you made the point that, institutional capital has really shifted to become more bullish on BTR. A lot of different reasons, from scalability to check sizes to politics and public image. Barring some kind of black swan event, do you think, again, macro level, institution as a whole, is that pivot here to stay?
I think it is. I mean, we looked at it pretty critically, and we have, so for us, I think that the build to rent definition would be helpful if we all sort of stopped and said, what do we mean by that? Because we've built thousands of homes, but we built them. If you drove through one of our neighborhoods, you wouldn't tell it's not a rental neighborhood, right? It's just it's just a neighborhood full of homes that we built specifically to offer up as rentals instead of the homeowners. Other people have developed this cool product where it's one plat. You got a bunch of small buildings on it. You have parking that's not attached to the home. It's very much a different product. It's basically more, I think people have called it the horizontal apartment complex. So we haven't figured that product out. We looked at kicked lots of tires. Other people have made money on it. We couldn't figure out who the customer was, how durable the customer base was, why they wanted to live out where these parcels were available. And I kind of look at it as like, well, if I was going to live in an apartment complex, I'd probably rather live in that apartment complex than one where it's the traditional, multi-story garden apartment complex. But I felt like the apartment complex generally is for a relatively shorter period of one's life. Right? Sort of between, we have this map. So one of our guys mapped this out. I'm not going to do it justice, but it's something like you go from your parents' house to your dorm to your, what do you say? It's like to your bud's house or something where you've got like multiple people sharing an apartment or something. Yeah. And then you go to your girlfriend's house, and then you go to your wife's house, right? So something like that. And I think that and that's why the turnover rate's 50% multifamily, right? Is that it's a waypoint along the way to another destination. And maybe this horizontal product fits that customer base better, but we don't think it's the same customer or going to have the same performance dynamics as single family houses. So it's like a fancier, cooler, neater, new apartment complex. It's not like an alternative to single family housing in our view.
Yeah.
Because it doesn't have the features, right? The separate lot, your own land, the big backyard, and your own garage, and all this stuff. So I just think it's a different. It's neat. I've walked lots of them, and they're really cool. But I just figured out that for what we do and the scale we do it, I can't figure it out. So we have built a bunch of neighborhoods that are just separately detached 50-foot lots, 2-car garage.
Well, it seems from the Burns data that I've seen that the scattered site homes, whether it's a community or true scattered homes, have seen more rent growth than the more multifamily-like SFR.
Yeah, and I think that's a function of like supply, demand, and
Yeah.
the customer base. And remember, like what we're like, I didn't explain it well, but our customer base are like the top 300 or 400 institutions in the world, right? That's all we try to provide service to. So what do they need? They need something that's not particularly risky, right? They need something that's super scalable. They need something that's not politically incorrect, right? And they need something that's going to produce alpha, right? It's going to outperform inflation, and as a big manager, it's super hard to outperform inflation, right? So that's how we got into the arbitraging of mortgages, and that's how we got into single family rental. Is that we think it ticks all those boxes. But when you start sort of messing around with the product, then all of your underwriting becomes sort of questionable, and you can't really scale it, right? But I think they're cool. I've looked at some of them, and they're neat. It's neat when you don't have the city's ordinances to make. Like, I don't like the fact that the garage faces the street on so many of our homes, and the BTR guys can tuck the garage around the back or make a parking lot. So they can make it like a prettier little neighborhood, but it's a different thing. It's a different customer.
So is it fair to say then, like, you think there'll be a continued shift on construction instead of acquisition, but that may be more scattered, detached single family homes as opposed to the communities in your case?
We're on what may be sort of a whole bad idea mission because of these things, right? Remember, like we're underwriting for people that are going to own something for 20 or 30 years. If they're going to invest in the space and open up an expertise and a team and go through investment committee and all this stuff, if they manage $1 trillion and they take a 1% position, they need a $10 billion thing over the next 10 years or something, right? So like, we can't be too creative on product because you can't give them any how do you underwrite it? Like, what's it going to be 20 years now? No idea. So we're on this mission that could be, it could be the reason they finally throw me down the stairs around here. But we're trying to. So here's what we figured out. Here's the problem we figured out. We haven't figured out a solution. The problem we figured out is that the nation's infrastructure to develop single family homes is designed to build batches of them, right? And so you just think about how Pulte does so well, or D.R. Horton does so well, Lennar does so well. They go, and the whole infrastructure, the whole ecosystem or supply chain, we call it, is designed to go build batches. So like the foundation guy doesn't want to come sell you one foundation. The framing guy doesn't want to sell you one frame. The roofer doesn't want to sell you one roof. Electrician, plumber, cabinetry, whatever, right? They want to sell you 5, 6, 10, sell that 2 a month out of a neighborhood and then go, right? However, these homes don't last forever, right? You can see this. So when the home gets to be 70, 80, 90, 100 years old, or it was designed in a way that its product status becomes out of favor, like people don't want to live in a 3-bedroom, 1-bath home anymore, right? Then you have to take that home down and rebuild it. There's no ecosystem supply chain in the US that does that effectively. To go into a neighborhood, take down one house, go in and put in one new house, not a mobile home, not some crazy thing, but like a house, to do it in a way that is as efficient as building a neighborhood. So that's what we're doing. So we've built out most of the pieces to be able to, just like we buy one home, renovate it, and operate it as a rental, buy a vacant lot that was never built on, or a home that burned down, or a home that's 80 years old, take that thing to the ground, redo the land, and build that one house and do it. And right now we can do it at about the same price as it costs to build a home in a neighborhood.
Wow, that's impressive.
Think about that. What that does to my underwriting? Right now, I'm underwriting like an infill location. I'm underwriting a single family detached house. All of a sudden, I can think about 20, 30 years of price history and think it will apply to the thing I'm building today.
Yeah. So is that how you kind of see BTR evolving, is more to the, finding a lot so you can build on?
Right now, we're the only people dumb enough to try this in scale. So I think that we built a factory. So we're using some, about 80% of the home was built offsite, and that helps in this scattered site new build strategy. So like I say, I wouldn't say that we've succeeded at it. We've probably built 300 of them or something, 400 of them. But man, we have high hopes that it's going to make a big difference for the United States, because I can go into the urban core in Houston or Dallas, San Antonio, Atlanta, Charlotte, you pick it. I can take down a home that really no one should be living in. A lot of times it's got lead-based paint, asbestos, iron pipes, all this stuff. And I can put in 2 homes, but I can also take out a rental unit and put back 2 rental units. Because what you normally see is the 4-letter word of gentrification, is problematic. People should be upset by it, because a lot of times, like in Austin, you had this big rental community just east of I-35. When Austin grew so much and home price went up, the people that owned those homes sold them, but they were all rental homes. So the families living in them had to leave Austin basically because the rental home was replaced with the for sale home. Our strategy takes one rental home down and puts up 2 or 3 rental homes.
That's great.
So I think that it's, I wouldn't say that it's going to be the future of the industry because we haven't figured it out yet. Because there's cost overruns, there's pushback, there's regulatory pushback, all the problems you have to develop,
you know, the right zoning
200
and all
homes,
that.
you have for that one home.
Yeah. And a related question, does it matter how you have to, is it only work within a certain proximity to this factory?
So our factory is almost it's almost in Victoria, Texas, in a town called Cuero, which puts it like 100+ miles south of Austin. And I can deliver houses to Dallas pretty effectively. So call that, whatever that is, call that like a 4 or 5 hour drive, 6 hour drive, maybe. That's kind of the range. It just becomes a little bit weird. Now we have had recently some people come in and we sell the homes at our factory too. We don't develop them all. We'll build and sell them at the factory door. We've had recently some guys try to buy homes and move them out to California, which I can't imagine driving an entire house over the Rockies, but
yeah.
But that just is the cool thing is that I have a whole group of people who work indoors in a factory who have like full benefits and full wages and the ability to have career progression, building homes. And,
that's great.
And they're in Texas where wages are lower and everything is, it's a business friendly place. And I can sell that home. So I can build that home in a small town. I can build and I can sell it, basically rent it in a big town. So there's a little bit of price difference. So I don't know. Like I said, we're excited about it and we talk about it like it's a huge success. It is a success, but not, there's a lot of moving parts. So we're trying to systematize land acquisition, lot prep, permitting, assembly, all that jazz.
Yeah, no, it's great. One last question for you. Obviously, counter to narrative, there's very few institutional purchases of homes off the MLS these days, but true institutional purchases. But I'm curious, okay, so then with that, I mean, first of all, what does that really mean in terms of size? Because I would guess it's still relatively small. And then secondly, what's the profile of a deal you'd actually want to buy off the MLS these days?
So I would say we're sort of in the $50 to $100 million a month pace of acquisitions. Which is not terrible, but that was 10 times at one point. The profile, so we're indifferent, right? But the ones we get to win are the ones that really benefit from our construction management platform that we built. So they're the ones that are 25 to 35 years old, and generally the previous owner got a lot of the goodie out of them, right? They stretched the life of the roof, the HVAC, the bathrooms, the kitchen, the flooring, they've got a lot of the good out of it and haven't sort of tried to come back in and freshen the home. That's the ones that we buy more often than not. And it's because our cost to renovate the home, and when you say renovate, we're not moving walls, we're not changing the floor plan, right? It's basically updating, kind of like what you would do in a PIP in a hotel. But that updating, we could get done super fast, and we've innovated on supply chain, so our pricing is pretty good. So for what amounts to like less than $20 a square foot, we take a $200 square foot home and turn it into something that's pretty worn out and tired, into something that looks like it just came out of DR Horton and Lennar's plant.
Good.
So that's pretty cool that you can sort of catch up all that deferred maintenance that fast. And so that's the stuff that we buy mostly, is a 30-year-old home that has had 30 years worth of good use.
Is that another opportunity from public image perspective? Like, hey, look, these are houses that, your average home buyer, if they're even buying at those prices, might not because they can't afford the updates or the repairs. And number two, just modernizing older homes. I mean, those seem like important things.
Yeah. Well, we try to say that, but we're not very good at tooting our own horn. But yeah, we show a lot of pictures like the befores and afters. And that also, when people really dig in to say, what is evil private equity Sean doing to the housing market? And they actually open up the books and they look and they're like, oh, okay, I get it. Right. I get it. There's a reason that they're the scale they are. And that's one of them, is that these homes need love. We're not the only ones that do it, by the way. Flippers, about 10% of all home sales in the US go through a flipper. And it's for the same reason. It's because when they come to market, they're just not in move-in condition.
Right.
Yeah.
Well,
that's what we need to say it more often.
Yeah. Well, Sean, I appreciate your time. It's been just fascinating to chat with you. So thank you for the time, and appreciate all you're doing.
Well, but we appreciate the opportunity to get to come to our story. Nice job on the podcast. Thank you.
Thank you, sir. And that's a wrap on episode number 45 of the podcast. A big thank you to JPI, to Waymaker, and to Elise AI for sponsoring today's episode. Thank you to all of you for spending part of your day with us. And we'll see you next week when we dive into the top 5 takeaways from the apartment REITs Q2 2025 earnings calls. We'll see you then.